Okay, let's take a look at another question. Here we go. Problem 9-18. Sorry guys, I'm just getting over a cold and I'm constantly coughing here. So, we are given a balance sheet as of April 30th. The company is in the process of preparing a budget for May, and then we're given some data. Sales are budgeted at $200,000. Of these sales, $60,000 will be for cash. The remainder will be credit sales. One half of a month's credit sales are collected in the month the sale is made. The remainder is collected the following month. All of the April 30th accounts receivable will be collected in May. Purchases of inventory are expected to total $120,000 during the month. These purchases will all be on account, 40% paid for in the month, the remainder paid in the following month. All of April 30th's accounts payable will be paid during May. The May 31st inventory balance is planned to be $40,000. Selling and admin expenses for May are budgeted at $72,000 exclusive of depreciation. These expenses will be paid in cash, and depreciation is going to be $2,000 per month. The note payable that exists right now will be paid during May, with $100 in interest also being paid. New refrigeration equipment will be purchased for $6,500. And during May, the company will borrow $20,000 from its bank. And then we're asked to do a cash budget, an income statement, and a balance sheet. So, prepare a cash budget for May. Support your budget with a schedule of expected cash collections from sales and a schedule of expected cash disbursements from merchandise purchases. So, cash collections from sales. So, what I tend to do is I read through the question once. And I'm not paying attention to the numbers so much. I'm just trying to see what kind of information are we given. We're told what sales are. We're told that some of them are cash, some of them are on receivable, on credit. So that there makes me think then if we're doing a balance sheet and income statement, then we're going to have, that's where our accounts receivable number is going to come to. So I keep that in mind. We're already given a balance sheet to start off with. So then I also think about this there, that there's an existing amount there that should be collected in this month. I look and I think, okay, inventory, so we know what our inventory purchases are going to be, and they're paid on credit. So again, our accounts payable and cash disbursements. Whenever I see selling and admin expenses, I always think of the depreciation. Is it included in that number or is it separate? So these are little things. So I do a quick once through. Then I get to the question and I say, okay, we have to do a cash budget. So cash collections. I know we read about that. So our sales are $200,000 for the month. Of that $200,000, $60,000 is for cash. So that's received that month. The remainder, so the 200 minus the 60, so the 140,000 are credit sales. Half of which will be collected this month, half will be collected in the following month. So our cash receipts, our cash sales, which we said was 60, and our May sales, which is 50% of the remainder, so 200,000 minus the 60 was the 140, and 50% of that will be collected this month. This number here, then the 70,000, is also going to make its way and be an accounts receivable in our statements. And then also the April 30th accounts receivable will be collected in May. So there already is 54,000. That's going to be collected this month. So this is our cash receipts. Our cash payments, purchases of inventory are expected to total $120,000. They're all on account. 40% paid in the month of purchase, the remainder paid the following month, and all of the accounts payable will be paid during May. And the accounts payable is $63,000. So the April 30th balance is going to be paid, and our May purchases of $120,000, 40% gets paid this month. The other 60% is going to be in accounts payable on our financial statements. So when we do our cash budget, again, if you're doing this in an exam situation, I want the headings. Our beginning cash balance Well, cash over here, $9,000. So we have a beginning balance of $9,000. Collections from customers, we're expecting $184,000, so we have $193,000 of cash available. Less our disbursements, so our purchases of inventory, $111,000. Selling and admin expenses, that comes from the information given over here in Part D. It's $72,000 a month. And that was excluding depreciation. That was the actual cash portion. So that's $72,000. And we were also told here that we were going to be purchasing a new equipment, and it will be purchased for cash during the month. So that's going to affect our cash. So that means our total disbursements, $189,500. So that we're receiving $193,000, we're only spending $189,500. So our excess cash available is $3,500. Now financing, we are told two things: that there's going to be a new note in May of $20,000, and we are told that the existing note will be paid during the month. So the existing note here is $14,500 with $100 interest. So we're going to borrow $20,000, we're going to repay the existing note of $14,500, and we're going to pay interest of $100, which is our financing is going to total $5,400. So our excess cash plus our financing will leave us with an ending cash balance of $8,900. So when you're doing the cash budget, you're basically going to look through everything that's given, and we know that sales, we're going to receive money from the cash and from our from the sales that were on credit. Inventory, we're going to pay for some inventory that we purchased in that month, plus we're going to pay for the inventory, the payables that we already have. Inventory balance, not going to affect our cash. Selling and admin expenses is going to affect our cash, because we're paying it in cash right here. And then the note, and the old, paying off the old note and receiving the money from the new note, and the purchase of for cash of the equipment. So you're going to read through and you're going to find anything that affects your cash and put it into your cash budget. Then prepare a budgeted income statement using the absorption costing method and prepare a balance sheet. So same thing, don't forget to put in your headings. So our sales of $200,000, that we are told sales for $200,000 in May. Sales less your cost of goods sold. So our beginning inventory. Add your purchases to find out what goods are available for sale. Subtract your ending inventory to get your cost of goods sold. So beginning inventory is going to come from the information in the balance sheet, $30,000. Purchases of inventory are expected to total $120,000. So that means we have $150,000 available for sale. Ending inventory, the May 31st inventory balance is budgeted to be $40,000. So less our ending inventory is our cost of goods sold. And then our sales less our cost of goods sold is our gross margin. Then we have selling and administrative expenses. So remember that we were told that there's $72,000 for the month, but that's excluding our depreciation. Depreciation is $2,000, so we take the $72,000 that's going to be paid plus the $2,000, that's also an expense. $74,000 is our selling and admin, which leaves us with an operating income of $16,000. And then remember, we had interest expense when we paid the existing note. There was $100 in interest that related to May, which leaves us with a net income of $15,900. Our balance sheet. Remember your heading. Assets, cash. Hold on here. That was our starting cash. $8,900. That was here from our cash budget. $8,900. Oops, I didn't mean to click back. I meant to scroll down. Accounts receivable. So again, we were told that 200,000 in sales, 60 were cash, so 140 was on credit. Half collected in that month, half collected the following month. So the half that's collected the following month, the 50% of that 140 is our accounts receivable. Inventory of 40,000, that comes directly from the inventory here, 40,000. Buildings and equipment net of depreciation. So we go back because we had 207,000. We purchased 6,500, but we also have depreciation of 2,000. So our beginning balance plus the new equipment that we purchased less depreciation gives us our total. So then we have total assets of 330,400. Accounts payable, again, I pointed out when we looked at this that we're expected to purchase 120,000. It's all on credit. 40% paid that month. The 60% that's left of the 120 is an accounts payable to be paid next month. Our note payable, well, we had the 14,500, but that was paid, and we had a new note of 20,000. So the new balance now is 20,000. Our common stock here comes right directly from the given information in the balance sheet, and our retained earnings are the existing earnings that were in the balance sheet given, plus our net income. Okay, so hopefully that's clear to you and helped a little bit. That's it for that question.